Personal loan. This is one of the most common types of borrowing, and it works exactly the way it sounds. You borrow a fixed amount of money from a bank or lender, and you pay it back in regular monthly installments over a set period of time. Personal loans are usually unsecured, meaning you don't have to put up any property or asset to get one. Lenders decide whether to approve you based on your credit score, income, and financial history. People use personal loans for all kinds of reasons: medical bills, home repairs, travel, or simply covering an unexpected expense. The interest rate you get depends largely on how trustworthy you appear to a lender on paper. Mortgage loan. When someone wants to buy a home but doesn't have the full purchase price in cash, which is nearly everyone, they take out a mortgage. The lender pays for the property, and the borrower repays that amount over many years, typically 15 to 30. The home itself serves as collateral, which means if payments stop, the lender has the legal right to take the property back through a process called foreclosure. Mortgages have been around in various forms for centuries, but the modern fixed-rate mortgage became widely available in the United States after the Great Depression, largely to make homeownership more stable and accessible. The monthly payment covers both the original loan amount and interest, and over time, the borrower gradually builds ownership, known as equity, auto loan. Buying a car with cash is something most people simply can't do, so auto loans exist to bridge that gap. A lender, often a bank, credit union, or the dealership's own financing arm, covers the cost of the vehicle, and the buyer repays it over a few years with interest. Like a mortgage, the car itself acts as collateral. If payments aren't made, the lender can repossess the vehicle. Interest rates on auto loans vary quite a bit, depending on credit history and whether the car is new or used. Used car loans typically carry higher rates because the vehicle depreciates faster and represents more risk to the lender. The loan term usually runs anywhere from 2 to 7 years. Student loan. Education is expensive, and student loans were designed to make it possible for people to attend college or university without paying everything up front. There are two main categories: government-issued loans and private loans. Government student loans generally offer lower interest rates, more flexible repayment plans, and in some cases, forgiveness programs for people who enter certain public service careers. Private student loans come from banks or financial companies and tend to have stricter terms. Repayment usually begins after the student graduates or leaves school, though interest often starts accumulating earlier. Student debt has become a major economic issue in many countries, particularly in the United States, where total outstanding student loan debt runs into the trillions. Business loan. When a company needs capital to expand, hire staff, buy equipment, or simply survive a slow season, a business loan is often how they get it. Lenders look at the business's revenue, history, credit, and sometimes the personal finances of the owner. Some business loans are secured against company assets, while others are not. Small businesses often find it harder to qualify than larger, more established ones, which is partly why alternative lenders and government-backed loan programs have grown over the years. The Small Business Administration in the United States, for example, guarantees certain loans to reduce risk for lenders and improve access for smaller borrowers. Terms and amounts vary enormously depending on the size and nature of the business. Payday loan. This type of loan is designed for very short-term borrowing, usually meant to be repaid on the borrower's next payday. The amounts are small, sometimes just a few $100s, and the approval process is fast, often requiring little more than proof of income and a bank account. That convenience comes at a steep cost. Payday loans carry some of the highest interest rates of any lending product, and when expressed as an annual percentage rate, the numbers can seem extreme. Critics argue they trap people in cycles of debt, since borrowers who can't repay on time often roll the loan over, adding more fees each time. Despite the controversy, payday loans remain widely used by people who have no access to traditional banking or credit.